And good morning. We are the Price Group, and as our continuing tradition, welcome to our 2021 Market Outlook. We've titled our remarks today On the Road to a New Normal, whatever normal is in the COVID crazy times. So welcome. If you have any questions, please email matt.price at stewardpartners.com. And we'll try to get to many of those questions as we can. We're going to try to be on time here, make good use of your time, and we've got a lot of information to try to share with you here. So who are we? Thank you for those of you that have been here before. You know who we are. We're a boutique firm that specializes in retirement planning, family owned and operated, a lot of years experience from our group. We're fiduciaries, and 90% of our clients are indeed retired. So anyway, let's talk about a couple of things here. Who should you listen to? Who should you believe? With regard to that, we have some Wealth Coach podcast videos that go out each week. We're humbled to receive some accolades and some awards from Barron's, Forbes, Financial Times. Matt and I are both certified financial planners and attended the Wharton School to achieve the SEMA designation. So we're going to share some of our experience and some of our thoughts with you, and again invite your questions with regards to that. Several of you very familiar with us, but we do have a number of new folks that are not familiar with the Price Group. So thank you in advance for your time, and we hope to meet or exceed your expectations here this morning. Get us started. This is an Olympic year, Summer Olympics every 4 years, and Tokyo will be the host for these games. 75% of people say they're excited to watch the Summer Olympic Games. Track and field, gymnastics, and swimming are some of the most popular items on there. So we talk about where we have been, where we are now, and where we are going. Obviously, we come off of 2020, and it's been a year for the record books between COVID, stock market volatility, etc. And again, let's jump into where we've been through the past year.
Here's a real neat look at the U.S. stock market, the S&P 500, dating back to 1900. So we have about 120 years worth of data here, and I want to draw your attention first and foremost to this red period, 1972 through 1981, and about a 16-year bear red period where the market went up, the market went down. Ultimately, the market went sideways. And so there are prolonged periods in history when the market has not gone up straight up, kind of like it has over the last 8 to 10 years. And so one of the questions we get the most, the market is making new all-time highs. Should we be nervous? What does this mean to us? When we go back and look at these average bull markets, the green periods, the good periods, the average bull market is anywhere from 15 to 20 years. So we would argue that the bull market started spring of 2009, means we are, call it 11, maybe 12 years into this bull market. We do think there are legs left, the few innings left to go in this bull market. With that being said, though, that doesn't mean that we are not going to see periodic pullbacks along the way. Even during these bull market periods, you do get a 10 or 20% pullback from time to time.
So oftentimes we get asked about what does this mean, this period of time. If you're not going to invest in stocks, clients will typically need income and will invest in bonds. We've heard the comments about bonds being safe. Historical look here at some treasury bills and treasury notes through 3 periods, 1920 to 1940, 1941 through 81, and 1982 through 2009. And what we can see is bonds do well during certain periods of time. They did very well in the extreme left and the extreme right. In the middle, they struggled. They struggled because of inflation. And they actually had what we call a negative real rate of return after you factor in inflation. You lost money on fixed income. So what everybody is most interested in is not what's happened historically, but what happens as we go from here. And we'll be talking a little bit about that. What does that mean to each of us, to each of you, is two things. One, bonds can be risky, perhaps not as risky as stocks from a standpoint of the fluctuation or the volatility in any one day, 1 week, 1 month time period. But they can over time lose purchasing power, and retirement is all about purchasing power and being able to buy things. And so bonds are risky, and they also very much need an investment process to manage your fixed income as well as your stocks, especially when you retire. Things typically are more income oriented. And so we specialize here at the Price Group with regards to an investment process on both stocks and bonds. We'll talk a little bit more about that as we get through some of the additional slides. So let's talk about the economy here, trying to get up to speed on the economy. Obviously, 2020, how many times did you see the word COVID? The economy you might describe as sort of a big truck. Doesn't go from zero, doesn't stop very quickly, doesn't start very quickly. But what happened was we came out of the gates in 2020. The economy was looking good. Interest rates were low. Jobs were plentiful. Inflation was low, et cetera. And then all of a sudden, the virus came out of left field, what you call a black swan event. And basically, the economy just shut down. The ramifications were one for the record books. It had never been done before. So we pushed the stop button, had everybody stay inside, businesses stop producing, et cetera. And workers started working from home. And then the government said, wow, we can't continue doing this. And so they had to do something to get the economy jump started again. The Federal Reserve took extraordinary measures, injecting liquidity. We had monetary policy. Congress passed several pieces of legislation to put money back in the pockets. This is important because about 70% of the US economy comes from consumer spending. So the government was doing everything that they could to make sure the consumer had confidence and the consumer was spending. And so we had low interest rates, quantitative easing, et cetera. Interest rates, which had not been really high for short-term money market, but they were still up in the 1 to 2% range. Interest rates basically went back to zero. And again, the Federal Reserve and the government were doing everything they can to get the economy restarted, that big truck rolling again. So the U.S. economy started gaining momentum. This chart shows the gross domestic product, which is the year-over-year change in the GDP, which is the sum of all the goods and services in the country. And not surprising, we saw a sharp drop in the first quarter of 2020 as businesses were closed. And then you had government stimulus and the central bank, Federal Reserve step in, and the economy started regaining momentum as some people went back to work. Look at it from the concept of the restaurants. They let in 25%, then 50%. And so things started to pick up. We've tried to flatten the curve on the virus, and the state governors began to reopen on sort of an erratic basis, but the economy did start gaining momentum. During this time, though, consumers were still spending, despite relatively high levels of unemployment. Consumers spent, especially on durable goods, automobiles, freezers, home office furniture. Home office furniture was up about 13%, You could look at things and say the consumer spending was down. People weren't eating out. They weren't doing some of the things for the economy, but a lot of them stayed. And one companies that made paint did very well because everybody said, "Well, I'm going to be at home. I'm going to paint that extra room, or I'm going to do this remodeling project and whatever." And so it was actually interesting to see as the bottlenecks occurred from what opened up quickly and where the consumer kept spending and actually accelerated their spending during time. And the chart, again, shows a couple of lines that talk about that. But yet there was a disconnect between sort of what consumers were doing and the stock market.
So let's take a little bit of a look at the stock market here and what still big picture, what happened in the past. We mentioned the economy kind of being like a big 18-wheeler going up a steep bridge. The stock market acted a little more like a sports car. We had the end of the longest bull market in history. We had the shortest bear market in history. And toward the end of this past year, we saw the Dow, S&P, et cetera, make new all-time highs. So it's a real juxtaposition here comparing the economy and the stock market. We've gotten a lot of questions from clients on why and how can the stock market be doing well when the economy is still lagging. We wrote about in some of our daily market COVID updates back in the spring, we wrote about it till we were blue in the face, how the stock market is a leading indicator. And so that makes a whole lot of sense. We think currently that the stock market is pricing in a full vaccine rollout here sometime to the end of the summer, and they're pricing in companies continuing to beat on their earnings expectations. So time will tell if that is true or not. But the stock market, that is, thinks that a recovery is happening and will continue to happen in the coming months as far as the economy goes. Here's a real interesting chart, we think, the black line being the stock market, the S&P 500, and the purple line being the volatility. We'll talk to clients, and clients will tell us, "Oh, I hate volatility." And you see that the volatility index is at the highest here, back at the end of I guess that'd be end of March when the S&P hit the low, and we'll joke with clients and say, well, you don't actually hate volatility, you only hate downside volatility. We've never gotten a complaint from clients when stocks are going up too quickly. So there is something to be said for that here, but you see the volatility has died down, honestly, since the summer months, and it's kind of stayed put as the market has continued to move higher. But looking back, this is, we think, interesting might not be the right word, but could be a helpful chart to sum up 2020. You can see here, this is each bar is a calendar year for the number of days where the stock market was up or down by 1% or more. And you can see the average is the black line. 2020 was well above the average. Actually, looking back, it's the most up or down days, plus or minus 1% since 2009. So it was, by any definition, a wild year to be a stock investor. Had a conversation just last week with a client, and the client said, well, if I just looked at my portfolio on the 1st of January of 2020, I closed my eyes and didn't wake up until Christmas or look at any news outlet or any statements, I would have been pleasantly surprised. Stocks did well, bonds did well, and it kind of looked like it was just a good year, but this chart obviously indicates it was a very bumpy year to get there.
Sort of continuing on that theme of conversation, again, often asked question, why did the stock market do so well? Let's talk about the 5 reasons that supported the stock market. Perhaps some of you have heard the old saying, don't fight the Fed, don't fight the Federal Reserve. The Federal Reserve is trying to be accommodative, put money into the system, lower interest rates, give the money supply a boost. It's typically a big boost for financial asset stocks as well. So We've had very supportive central bank policies, not only here in the United States. Our central bank obviously became the Federal Reserve, but central banks all across the world were jumping in as the COVID virus spread around the globe. Number two would be the government stimulus programs. Government has given back a lot of money through loans, forgiven loans, et cetera. And that has not only helped people get by, but given them confidence that there is hope at the end of the tunnel with regards to that. Interesting, the big five are the five largest companies that an interesting statistic on September the 2nd, these five companies, Microsoft, Apple, et cetera, accounted for about 25% of the total index if you weighted by size, what we call capitalization. They were up about 65%, amazing number, while the other 495 companies, again talking about the S&P 500 companies, the 500 largest companies in the country, the other 495 companies were up only 3%. So that was obviously a point of inflection. Some of the other parts of the economy have started to recover as well, but it's just amazing how much the five largest companies have factored in with regards to someone says, quote, how's the market doing, unquote. Well, do you mean the big five or the lower 495? Are you talking about the average of the two? Fourth reason stock market did well in 2020 is, as Matt pointed out, the stock market is forward looking. The market is not so much focusing on today as it is what's happening going forward. Stock market and investors like certainty, and again, you have prices being on sale, and so the stock market actually did much better than Wall Street did, but much better than Main Street during this period of time. During all this, we continued to have number five, low interest rate environments, so companies could borrow. The 10-year U.S. government bond, which is about 1% today, actually reached a low of 0.36% back in March. So interest rates on money market, short-term interest rates, if you will, were close to zero. And actually the 10-year U.S. government bond never got to negative. We've got negative rates some places across the globe, but we did have very low interest rates. Statistically, mathematically, interest rates have risen quite a bit from that period. Again, the 10-year bond this morning about 1.1%. So anyway, stock market did well, and that's looking in history. But let's talk about about bonds. You know, a bull market is when things go higher, do well. Bear market is when they do poorly. So one of the things that deserves a mention as well as a discussion, and we do not have time to, if you will, discuss this in probably the depth that it needs to be, but is this the end of the bull market in bonds? Let's review what's happened. And if you think back to that slide where I showed you that there are three periods in time and bonds had done well, and two of them, and the middle one during World War II and following, bonds had not done well. But in 1980, money market interest rates were over 20%. The 10-year government bond was about 15%. And so what happened during the 80s and the 90s? We've had a multi-year period where interest rates have not only declined, but declined demonstratively. Think about that. You could have bought a 15% 10-year bond, and today you can buy one for 1%, up from 0.36%. And yet they've been selling, the government's been selling a lot of them. So they've been selling a lot of them to who? Insurance companies, individual investors, people all over the globe. And as I mentioned, parts of the globe, you have countries with negative interest rates. So it's been a great period to own bonds. I talked to a client the other day, and he said, you keep mentioning this possibility of interest rates moving higher. He said, but in my lifetime, I've never seen it. So it's going to be a real challenge. And I agreed with him. I thought that was well said. It is going to be a challenge when you look at your fixed income and it's backed up in value. Interest rates and bond prices move just the opposite, sort of like a seesaw or a teeter-totter. Interest rates go up, bond prices go down. So if you hold a bond to maturity, that becomes a moot point. But again, to sort of repeat what we said, you need a process to manage your fixed income, I think, especially going forward, especially if you're retired and looking for income, looking to preserve purchasing power. And the bull market in bonds, we're not yet to predict it's over, but we think it's somewhat cloudy out there. And 2021 could be the year where bond interest rates continue to rise. We'll talk a little bit more about that as we go. So inflation, one of the big questions we get asked, wow, how come there hasn't been more inflation? And I think that is a great question because every central bank in the world, the United States Federal Reserve, as well as all others, they're trying to create inflation. There's only two ways out of this. One is deflation, or the second is inflation. Those that have lived through deflation back in the 30s will tell you inflation is a much better, even though inflation is a hidden tax, it is something that is trying to be creative. So the goal is to get to 2% inflation. 2% inflation doubles your cost of living every 36 years. This shows the 12-month percentage change, what we call the consumer price index. Some people call it CPI, in various categories there. And again, inflation has been heating up in some areas, but the key is not what has happened, but what going forward will happen. And what does that have to do with your portfolio, your planning? Because again, purchasing power needs to increase each year to keep you at the same standard of living. Another one of the questions we get asked, and this was a common question toward the end of the year, how are the politics of the presidential election, of the House, of the Senate elections going to affect my portfolio? There is a picture there of the S&P 500 performance under both Republican and Democratic presidents. And as you can see, the party in power is just one of the many factors that affects investment performance. And we do not think you should base your retirement or your investment decisions entirely just on politics, but they obviously are a consideration. Tax rates, monetary policy, government spending, et cetera, are all factors that enter in. And again, will give us sort of a recipe of what to expect going forward. But our thought process, keep politics out of your portfolio as much as you can.
So we talked a little bit about where we've been. Let's talk about where we are currently. These next two slides, a little bit of a juxtaposition. We are in some ways bullish based on the slide Randy previously talked about low interest rates. Don't fight the Fed. There's still a bunch of money sloshing around out there from the Federal Reserve. We think that companies continue to be profitable and increase in their profitability. You can see here over 49% of the people surveyed were bullish. At the same time, you know, we could say that we're bearish, where a lot of CFOs, 80% think that the S&P is actually overvalued, and it kind of goes back to another thing that Randy mentioned on which stocks are you talking about. We think moving forward, it's going to become more and more important about the fundamentals of the actual company that you own, opposed to the overall stock market index. And as we have over 36 clients on the call today, as most all of our clients know, we really like dividend-paying stocks, and we're focusing on companies that not only pay dividends, but have a propensity to increase those dividends year over year. And so what does that mean for clients? Well, even if and when there is a stock market pullback, their income stream should not be affected. And like Randy mentioned, income is really the number one goal of retirement. The second goal is don't forget the first, that income is the game in retirement. So before we kind of get to the future, we do think there is a rough road, could be a rough road to get there. The vaccine delivery, obviously there's been a bunch of challenges here over the past few weeks. I read some article over the weekend. They should be getting closer to 2 million a day vaccinations in there. We think the market has priced in a good rollout of that vaccine, having most everyone who does want to get it vaccinated here before the fall. Long-term unemployment, a lot of these jobs that did disappear in 2020, we think we're seeing people just permanently leaving the workforce. Some people are looking for part-time work opposed to a full-time job. And the hard thing to really kind of put your finger on is the small business destruction that we're trying to overcome from this past year. And the S&P 500 might not necessarily be a good representation of that, but the small businesses represent almost half of all the jobs in the U.S. I will say the small businesses that I shop at, people that I know that own them, work at them, I think they've been resilient, and it's been something really exciting is not the right word, but almost in awe to watch how these businesses have been able to respond and adapt in such a quick manner to keep servicing the needs of their clients. So economic relief package, seems like there's a new one of those every month almost out there. And so a big kind of hurdle as we move forward. Like we've said, we think the market is pricing in a good outcome on most all of these items.
Let's talk about where we may be going. Really the most important, I guess, part of the presentation here. Again, if you have questions as we move toward the end of that, matt.price@stewardpartners.com, and we'll try to get to as many of those as we can. So the 2021 economic growth outlook, estimated gross domestic product of some various countries there. Obviously, the numbers are high as companies come off of a bad 2020, where the first and especially the second quarter, the numbers were just crushing. So the world looks like it's going to grow each of those is going to grow their economies in 2021. That is good news. And the United States they're expecting 3.1%. We'll see if we can get over 3.1, or again, 3 is a very respectable number. So interesting sort of comment here. The world economies rarely move in lockstep. You've got developed, you've got emerging markets. That's only happened about a dozen times over the past 40 years. And we think the stage could be set for another such synchronization, if you will, beginning in the second quarter of 2021. And that, as the old saying goes, when the tide comes in, all the boats rise, and it looks like that could be the case. And again, let's hope so for a number of reasons.
Here are the 5 key risks we see for this year moving forward. How effective is the vaccine? Does it work against any new kind of different variants of COVID-19? How quickly do we recover? We think that the U.S.-China tensions heat back up. And what happens to consumer habits? We're habitual people, and we've gotten used to spending money in certain areas, not spending money in other areas. Do we revert back to how we were spending back at the end of 2019, early 2020, before the pandemic? Time will tell. And then also investment behavior. Investing, a lot of it, money changes hands because of fear and greed. and it's going to be interesting to see what happens from a standpoint of we saw a lot of fear. Do we start to see a lot of greed here in the 2021 time frame? So we've actually already had a couple of questions on this same this topic here, the debt levels that you're currently seeing for the country. What we're looking at is a total debt level for the federal government dating back to 1970, and you can see the big spike here last year. One interesting fact, when you look back and study world history, when the debt exceeds 90% of the gross domestic product, and that's what we're looking at over here on the left, which you can see it has exceeded that 90% threshold, economic growth falls on average by about 50%. So we do not think that this is necessarily a short-term problem in the weeks, months, or maybe even year or two ahead. But what we've done is we've stolen from the next generation and just kicked the can down the road. So how do we get out of this? No one from the government's called and asked for Randy's opinion nor my opinion, but we can spend less. That's the easy answer. And increase revenue is a second option. The third option, which would be the easiest, is you can inflate your way out of this. So you can pay back dollars that were borrowed with less valuable dollars down the road. And it isn't necessarily talked about in any of the Federal Reserve meetings, but that has to be one of their goals, to spark and create this inflation and just inflate your way out of, not all of, but a portion of this debt burden. And, here's an interesting quote from a private equity quantum fund manager, Jim Rogers. A year ago at this time, America, the largest debtor nation in the world, it went up by trillions. That's with the T. Someday we're going to look back at this, say, wait a minute, what about all this debt? And right now the market's not factoring that in, but at some point we think it is going to become a real issue, not only for our economy, but really across the globe. You're seeing this with a bunch of different developed countries as well.
So 2021, continuing with our thoughts, looking forward, much more important than looking backwards. Backwards always has 2020 vision. We expect the U.S. economic recovery to sort of reflect the pace of a triathlon, slow and steady. And you can see here on this this chart how the graph looks during various periods of time, and toward the right-hand side, looking forward to the time where we get back to, quote, normal, whatever new normal looks like. Economic activity normalizes, but a slower but a steady pace, and we finished the year with we think with an overall, as we've said, above average growth pace. And again, I think less stress and less drama would be welcome to all of us. So what happens to interest rates? We've titled this slide the duel of competing interest rates. The trajectory for interest rates is higher. We think the increase in rates will be limited. So we talked about the 10-year Treasury, which got as low as 0.36% back in March of 2020. Now about 1.1%. We think probably ends the year about 1.5%. But several factors could either influence that higher or influence that lower. The factors supporting higher interest rates, you've got the vaccine distribution. We talked about that, return to normality, near record fiscal deficits, elevated issuance of debt, improving economic growth, and unattractive real yields. On the flip side, lower rates, you've got muted inflation, aging demographics, the Fed being very accommodative, and an elevated foreign demand. So again, we've talked about this before. If you're a world investor and you're saying the dollar's perhaps attractive or not not unattractive, and you're looking at investing money in fixed income and you're saying, wow, I can get a positive rate of return in the United States, rule of law, et cetera, versus negative rates here, I'm going to take a chance. And so we've had foreign investors buying a lot of our treasury debt. So again, 1.5 is a nice target. Perhaps we get there. Perhaps the economy gets going and we overshoot that. But it was really interesting here a couple weeks ago. We went from 1 to 1.2 in literally about a week, and very interesting to see rates increase that quickly, which hadn't happened in quite a while.
A few more questions we've gotten by email here are about tax-free municipal bonds, and so this slide is probably in a good spot. Glad we put it in here. We're still a big fan of tax-free bonds for a few reasons. The Biden administration has been pretty clear that they plan to hopefully increase taxes on the highest marginal tax bracket, and so that's the case. Tax-free bonds become even more valuable than they were where tax rates have been for the last 4 years. So still not sure on will taxes change in 2021. Maybe it's kicked back to 2022. Time will tell, but we are still big believers in these tax-free bonds. The kind of the makeup, some general obligation bonds, which are paid by tax dollars, opposed to compared to the revenue bonds, which are paid by revenues. We still like both of them, and you saw these municipalities actually hold up rather well during 2020 with all the strains that were put in front of them.
One more thing about tax-free bonds. They measure tax-free bond demand by how much has gone into tax-free bonds on every 2-week period, and we saw the third highest inflow to that area of investments the last couple of weeks. So people are saying, I think the cities and states are recovering. I think there's going to be some stimulus to cover that. And I think tax rates are going to be higher. And so tax-free bonds. So actually, as Matt talked about, that supply-demand imbalance could really hold the value of help municipal bonds hold their value much better than their taxable counterparts. But as they said, we shall see. We think oil demand continues to recover. Largest annual decline on record in 2020. Crude oil demand is expected to be higher, and historically, crude oil prices have posted that gain in years of strong demand. Currently, about $53 a barrel or so, which is especially good for Houston. And a lot of the experts think that oil prices will end the year in the 60 range, average about 55 or so. And again, as some other factors come into play, but again, oil demand to recover, prices moving higher over the course of the year. So some tax changes with regards to what has happened in the legislative portion part of the world. We had the Secure Act, which is leading some people to look at some Roth conversions and this sort of thing. Tax policies could be radically different going forward. There's talk of making capital gains equal to ordinary income. Obviously, the COVID vaccine being rolled out, the multiple vaccines to combat the virus and hopefully flatten the curve on that. But there have been some changes with the Secure Act for stretching your IRAs. Historically, you could leave an IRA to your children and stretch it over 20, 30, 40 years. Now, for a non-spouse to inherit an IRA, husband dies, leaves his IRA to his wife. Wife dies, she leaves the IRA to the children. what happens is that IRA must be paid out over 10 years. You don't have to take anything out year 1, 2, 3 through 9, but by the end of the 10th year, it must be completely paid out. So the government's basically saying, I want my money sooner, and that has some real uh, uh, dramatic effects on legacy planning going forward. How do we get assets to the next generation at the most favorable tax rates? So again, we'll talk more about that individually as we meet with folks. But this slide trying to put a summary to what we've covered here. And again, these are our thoughts and subject to change, but we think the U.S. economy, as measured by the gross domestic product, increases at a really nice rate in 2021. We do expect lower rates of return for stock in the bond markets. If you were to put a gun to our head, we think stocks are in the 6 to 7% range. They have a little bit of a headwind here in that they've gotten out of the gate so quickly from recovery, and so the economy recovers and the stock market moves higher. We think, again, bond market, if we can even just clip the coupon and come and not have our bond values diminished, we think that's a positive. Again, that's because of interest rates and inflation moving higher. Continued pressure on the U.S. dollar, which could help non-U.S. investments. U.S. stocks move higher, but the earning growth slows. We favor small stocks and value stocks over growth stocks. All of this, number 7, very important, a solid vaccine rollout has been priced into the market. If that would not go well, or there would be mutations of the virus that the vaccine doesn't handle, that would be obviously an unwelcome sort of news, and would probably spook the market a little bit. The federal debt, as Matt talked about, rises to more than 100% of GDP. That's certainly not welcome. U.S.-China tension continues. And number 10, good for Houston. Commodity prices move higher. It's going to cost a little bit more to fill up your car with a tank of gas. So happy to, again, in person, and as it particularly relates to you and your family situation, explore this in a little bit more depth. But again, trying to just summarize for our portfolios and for our planning purposes what we think is going on in 2021.
So let's take a quick minute to just review what our Live Well plan is. Most all clients will be very familiar with this, but we think it's important. This is a plan. We don't just create it once and forget about it. We're updating this behind the scenes and usually looking at this more in detail, not after a really good year in the market, but after a bad year, and how your long-term game plan would be affected. But Live Well plan, how much can you spend in retirement? How long will your money last? What rate of return do you need in retirement? We love this quote by Benjamin Graham, who was one of the mentors to Warren Buffett. The best way to measure your investment success is not whether you're beating the market, but whether you put in place a financial plan and a behavioral discipline that are likely to get you where you want to go. We agree 100% with that. We don't think we're in the game of trying to outperform some arbitrary index. We're trying to meet the needs of the client, and we're trying to do it with the least amount of risk possible. And so we define the least amount of risk possible by establishing your family index number, which is what rate of return you need to be, quote, successful. We've had a number of clients actually tell us that they want the check to the undertaker to bounce. We'll have other clients whose goal is to pass along $1 million, $2 million, $3 million to each child, or to just to the next generation. And so that's a big factor in what rate of return do you need during retirement to not only meet your goals, but have a nest egg left over in the amount that you do want. So once again, family index number, we're trying to take the least amount of risk possible to achieve these goals. And this is a personalized rate of return. It's not anything that's cookie cutter from one client to the next. As far as do you need an investment process, I've had the opportunity to spend some time with some younger guys that are currently in college, one of them at University of Texas, University of Houston, and we're going through a book together and just trying to kind of pour into them. But I kind of had a awakening moment this past week when they were at my house having dinner, and one of them was giving me stock tips. And so when you have a college student giving you a stock tip, I think it's really important to come back, what is your investment process? And so discipline, income generation, we think are the core principles at our process. Our goal is to protect capital and generate a level of income and growth that meets your goals with confidence. We do think parts of the market have become really frothy, and we think moving forward, focusing on what you own is going to become more and more important. We're actually putting out a client email here later this week, kind of on some of the stuff you've seen with some of these speculative stocks on, and this is not a solicitation to buy or sell, but the GameStop, the AMC theaters, et cetera. So I'll be looking for an email update on that here in the coming days on there. But we really think a big part of our process, dividends matter. This is a neat chart looking back to the early 1940s. And what you can see here is the yellow, the mustard color, represents the dividend portion of the total return of the overall stock market. So dating back to 1930, a little bit less than half of your total return came from dividends. So not a rounding error, almost half is a big number, and we think that matters a lot moving forward, not only for our retired clients who need the income, but also for the total return of their stock portfolio. So like we mentioned, we're looking for companies that not only pay dividends, but that can increase their dividends year over year.
So an investing process is very, very important. If you look back 30 years and you measure how the average investor has done related to the various indices, this chart shows U.S. stocks, REITs, government bonds, and the average investor has sorely underperformed each of those indices, about even with inflation. And the reason is investing without a process, letting emotions get in your way. Many of you will remember Peter Lynch, who was the man pictured there. He wrote the book Beating the Street, and one writer asked him one press conference or just a period of time and said, Mr. Lynch, what is the saddest or the most disappointing decision or lack of decisions that you've made during your career? And he thought it was going to be something like, well, I didn't buy this stock at this time, or I totally missed it with this industry or whatever. And Lynch, without a hesitation at all, said, oh, that's an easy one. He said, the average investor in my fund nowhere near came close to the average return of my fund. And the reporter didn't understand that, and he went on to explain that every mutual fund company can measure the average investor, and they can look at when investor number 1, investor number 10, investor number 100 put money in, took money out, and they can give that average performance. And so the average investor put money in when things were going well. He took money out when things were not going as well, and therefore he was doing the opposite of buy low and sell high. He was shooting himself in the foot, and therefore the underperformance by the average investor. So we are big believers in that a live well plan helps, and it's sort of the foundation, the bedrock of everything that we do here at the Price Group. Our tagline is everybody needs a wealth coach. Tiger Woods has a swing coach, all the pros do. And so we'd love to interview to be your wealth coach. And that starts by creating a a Live Well plan, and we call it a Live Well plan because everybody wants to live well. Our Live Well plan creates clarity, comfort, and confidence. Many times people will say, for the first time, I really do have clarity as far as where we are, clarity about where we're going. That clarity will lead to confidence, that you have enough, you can take that vacation, you don't have to worry about running out of money. And then once you have that clarity and confidence, the thing that everybody is looking for is that comfort factor. I want the ride during retirement to be comfortable, take some of the ups and downs out of it, and let's just enjoy the retirement. So we're doing virtual meetings, etc. And again, would love to introduce you to the Price Group, what we do, how we do it, and show you the benefits of our Live Well plan. This time, and I'm happy to report we're running on schedule, we'll open it up for questions. Matt, I know you had a couple that we've already answered. What else?
I'll let you take this one. We kind of already touched on it. Long-term ramifications of the high national debt. What do you see as the long-term outcome?
Some point has to be addressed. Short-term, it seems to be an issue that the politicians and government officials, et cetera, wish to sweep under a rug. I think you need to have a flexible portfolio. I think you need to be aware of potentially higher rates, and diversification is always our friend. Not only just U.S. investing, but international investing, global investing, if you will, with an intent in mind of producing the income that you need and the real purchasing power. Because right now, if we do get into an inflationary time period, people have not seen inflation; they've not seen higher interest rates for a long period of time. So I think it's paramount on the bond side, the fixed income, if you will. Paramount on the stock side is always to know what you own, why you own, and make sure that it's meeting your needs with regards to that. So anyway, tough question. I wish I had the final answer, but I do agree with the slide that we had. It said at some point people are going to wake up, and when the bonds, people stop wanting to buy the fixed income of the sovereign United States, that's when it's really gonna be a different ballgame. So I appreciate each of your time for that. Please feel to reach out to us with comments. My email address and phone number, Matt's same information. That's Price Group. Tiffany and Melissa help us keep our promises, and our newest team member there, Maddie Kearns, on the far left side. So anyway, 5 of us. Again, we're a fiduciary, we're a boutique. We're here to serve families that are within 5 years or so of retirement, or again, wealth planning, investment planning. We'd be honored to sit down, have a conversation with you. If it's a good fit, we'll both know it. If not, we'll shake hands, part as friends. But we do feel everybody needs a wealth coach. Thank you for joining us. Have a good rest of the day. Be safe, and hope to talk to you soon. Thanks very much.